Okay, I want to work a problem here. I know some folks were working on this problem, and I wanted to cover it just to as kind of a review to show you how to handle a problem like this. We're talking explicitly about this one. Uh, this is a problem. Whoa, went too far. This is a problem where you have the classic 3-4. And we talked about that in class. And the only reason I call it a classic 3-4 is you're given three components, right, for the accounts receivable account, but you're not given the fourth. But you're given everything you need to back into that fourth one. So let's look first at the problem it says. So the accounts receivable account for Johnny's mechanic shop had a beginning balance of $35,000. During the month, Johnny made sales on accounts of $42,000, and the ending balance in the account, the accounts receivable account, is $32,000. And it asks you, basically, here's the missing piece. What are cash collections for the month? Well, the first thing that this problem requires is that you have to figure out what kind of accounts receivable is. Up here, nice and neat, we have assets equal liabilities plus equity. And you'll notice too, we have here nice and neat that assets go up with the debit and down with the credit, and then liabilities and equity are the exact opposite. They go up with credits and down with debits. Another thing you'll notice here in this little chart is that it also reveals the natural balance of each of these. For example, what causes an asset to go up is a debit, so its natural balance is a debit balance. This will become more apparent in a second. Liabilities, their natural balance is a credit. And equity, stockholders' equity, its natural balance is a credit as well. So let's look here. We're going to identify accounts receivable, and we're going to say, is it an asset, is it a liability, or is it an owner's equity? If you'll remember, accounts receivable is money we expect to collect in the next 30 days. If someone owes us money and we expect to collect it in the next 30 days, or if we expect to collect it in 2 years, it's clearly an asset. And that's significant because what that means is that the natural balance for an asset account, like accounts receivable, is going to be debit. So that's a huge clue right there. And it's telling you at the beginning of this month, or whatever cycle this is, it's $35,000. So here's accounts receivable, and its natural balance is a debit balance. So we go over here and we say, hey, we know we started with 35. And we likewise know that at the end of the month, right, at the end of this cycle, the accounts receivable account is 32. So see, knowing what the natural balance is for an asset like accounts receivable, we immediately know where to put two of these numbers that are in the problem. Then it says, during the month, Johnny made sales on account of 42,000. So now you're going, well, does 42,000 go here on the left-hand side, or does 42,000 go here on the right-hand side? This would be the last thing we're given. Remember I said we're given three, and we have to solve for the fourth. So what you have to ask yourself here is, okay, sales on account. Sales on account, remember I told you, anytime you see on account, it's either, if it's a sale, it's sales on accounts receivable. If you're paying, it's paid on accounts payable. But a lot of times it'll just say on account. This also is an important time to say, so you have your company, right? And you're asking yourself, is cash going this way, away from the company, or is cash coming towards the company? Okay? If cash is going away from the company, then that's an accounts payable. Okay? If we're going to have cash coming towards us eventually, then it's an accounts receivable. Okay, so if in 30 days we're going to owe something and then cash is going to leave the company, then it's an accounts payable. Inversely, if in the next 30 days cash is going to come towards the company, then it's an accounts receivable. This is money you expect to collect. This is money you expect to pay in the next 30 days. You being the company. So the company here clearly made sales on accounts receivable of $42,000. Okay? So that means that you sold stuff but did not collect it. These are sales on accounts receivable. Well, of course, if you make sales on accounts of accounts receivable of 42,000, you have sales revenue. You've earned it, right? I mean, you clearly have earned the revenue. The only thing you have not done is collect it yet. The reason I put it here in a T account is you can actually see the debit and the credit. Here's the credit, and here's the debit. Beginning balances and ending balances don't have offsetting debits and credits because they're the result of debits and credits that came before. So now you have it all set up. You've got your 3. You're going to solve your 3 for 4. Accounts receivable is an asset, normal debit balance. So here's what you begin with, what you end with, and this is the sales on account. Sales on accounts receivable. So there's sales, and here's your amount that you added to the accounts receivable account that you expect to collect. So when it's asking what are cash collections, well, keep in mind that when you collect cash, right, we're talking about collecting cash. When you collect cash, cash goes up. So some amount here is going to go up. Cash is an asset. Assets go up with a debit. And inversely, that means when you collect the cash, right, it turns into an immediate asset, but that means you lower accounts receivable. Accounts receivable is what you'll collect in the next 30 days. So basically what you're doing is backing into what this is, and that would be the cash collections. So if you take 35 and 42, right, and then subtract 32, you back into what cash collections had to be. In this case, it's 45. And cash collections here, 45. I'm showing this so you can see all the sides of it. So you started with 35, you ended up with 32. Here's your cash collections, and this is how much more you sold during the month on account, on accounts receivable. You booked the revenue because you've earned it, and then you're waiting to collect this 42,000. But this has to be how much was collected here via cash so that you could end up with 32. So the answer is 45,000. This is, again, when you see a problem like this, you're looking at a classic 3-4. The biggest thing you've got to solve is, what is this exactly? What is accounts receivable? Identify it as an asset, which tells you immediately which normal balance it should have with its beginning and ending balances. And then you've got the sales on account. And remember, if it's money coming towards you, it's sales on accounts receivable. If the money's going out in the next 30 days, it's sales, or it's paid on accounts payable. I think where it throws people off is the problem won't say sales on accounts receivable, right? It doesn't say sales on accounts receivable, and that throws you off. But sales on account is accounts receivable. Paid on account is paid on accounts payable. And this is how you back into your answer when you're given 3 or 4 in an accounts receivable account. I hope you found this useful.